Real estate investing is often marketed as a fast track to wealth, financial freedom, and passive income. While it certainly offers enormous potential, it's not without its landmines, especially for new investors. The path to success is littered with costly mistakes that can derail your investment journey before it even begins. In this video, we'll count down the top 10 mistakes new real estate investors make and show you how to avoid them, so you can build a profitable and sustainable portfolio. Number 10. Lack of a defined investment strategy. Many new real estate investors dive into the market without a clear plan. They might purchase properties because they've heard real estate is a good investment, but they haven't clarified whether their primary goal is cash flow, appreciation, tax advantages, or portfolio diversification. Without a defined strategy, it's difficult to make informed decisions about what types of properties to buy, how much to invest, or how to manage the properties long-term. For example, investing for rental income requires a focus on stable cash flow, tenant demand, and operating expenses, while flipping homes focuses more on purchase price, renovation costs, and resale value. Some investors even combine strategies known as the BRRRR method: buy, rehab, rent, refinance, repeat. Each of these approaches carries different risks, timelines, and resource demands. Start by clearly defining your financial goals, risk tolerance, time horizon, and available capital. Research various investment strategies to determine which one best aligns with your situation. Establish measurable benchmarks for success, such as a desired cash-on-cash return or annual appreciation rate. Number 9. Letting emotions drive decisions. Emotional attachment to a property can cloud judgment. Some investors fall in love with a house or fear losing a deal, leading them to overpay or ignore warning signs. Real estate investing should be driven by data, not emotions. Successful investors analyze numbers, project returns, and rely on factual information to guide their purchasing decisions. Emotional decisions often lead to chasing bidding wars, falling for attractive features that don't add value, or ignoring clear financial risks. When emotions take over, investors may compromise their standards, overlook red flags, and ultimately jeopardize their investment's profitability. Always let numbers guide your decision-making. Use tools like ROI analysis, rental comps, property inspections, and market research to evaluate deals. Build an objective checklist for every purchase that keeps your emotions in check and ensures each deal meets your criteria. Number 8. Skipping thorough due diligence. Failing to conduct comprehensive due diligence is a common rookie mistake. Skipping inspections, failing to review legal documents, or ignoring neighborhood research can expose investors to hidden structural problems, legal disputes, or neighborhood decline. Due diligence protects investors from unforeseen liabilities and ensures they fully understand the property they're acquiring. A thorough due diligence process includes verifying property boundaries, obtaining clear title reports, assessing environmental risks, reviewing zoning laws, and understanding HOA rules where applicable. Without this step, investors may face unexpected lawsuits, fines, or major repair costs after purchase. This mistake can be avoided by work with qualified professionals, inspectors, attorneys, title companies, and appraisers to uncover any issues before closing. Review all financials, leases for multi-unit properties, and tax assessments. Due diligence may cost money up front, but can save you exponentially more down the road. Number 7. Ignoring current and future market trends. New investors sometimes neglect to study both current market conditions and future trends. Economic indicators such as employment growth, infrastructure projects, and population shifts can greatly influence a property's long-term performance. Ignoring these factors can lead to purchasing properties that underperform or depreciate. For instance, an area may look affordable today, but if industries are leaving and unemployment rises, property values and rents may collapse. On the other hand, identifying up-and-coming neighborhoods can lead to excellent long-term gains. Avoid this mistake by staying updated on both macroeconomic indicators, interest rates, inflation, national employment, and hyperlocal data, job growth, school ratings, crime rates, development plans. Attend city council meetings, read local business journals, and consult with local real estate agents who know the market intimately. Number 6. Underestimating renovation and repair costs. Renovation expenses often exceed initial estimates. New investors may overlook hidden issues like outdated wiring, plumbing problems, or structural defects. Inaccurate budgeting can quickly erode potential profits. It's crucial to obtain multiple contractor estimates and include a contingency fund for unexpected repairs. Many renovation projects suffer from the HGTV effect, where investors are overly optimistic about timelines and costs. Even small cosmetic projects can run into thousands of dollars when unexpected issues are discovered once work begins. Avoid this mistake by getting at least 3 contractor quotes and itemized bids. Conduct a detailed property inspection prior to purchase, including plumbing, electrical, roofing, HVAC, and foundation. Build a contingency fund of 10 to 20% above estimated costs to absorb surprises. Plan for time delays as well. Contractor schedules often shift. Number 5. Insufficient research and education. Jumping into real estate without adequate knowledge can lead to avoidable mistakes. Real estate involves legal complexities, financing options, and market analysis that require thorough understanding. Investors should invest time in education, reading books, attending seminars, and learning from experienced professionals before making significant financial commitments. Without education, investors risk misunderstanding local regulations, tax implications, or financing structures. One poorly structured deal can set an investor back financially for years. Avoid this mistake by dedicating time to learning about real estate investing through books, podcasts, online courses, and mentorships. Build a network of trusted professionals, real estate agents, lenders, attorneys, and experienced investors who can help you navigate your early deals with confidence. Number 4. Failing to accurately calculate all expenses. Many beginners only consider the purchase price and mortgage payment, ignoring other costs like property taxes, insurance, maintenance, management fees, and vacancies. Failure to account for these recurring expenses can strain cash flow and reduce returns. A comprehensive financial analysis ensures that the investment remains profitable even when unforeseen expenses arise. Operational expenses like lawn care, pest control, HOA fees, capital expenditures, roof replacement, havoc repair, and tenant turnover costs are often underestimated or ignored entirely. Avoid this mistake by building a complete pro forma that includes all recurring and one-time costs. Study average repair costs for each system in the home. Work with a real estate accountant who understands how to model cash flow accurately and conservatively. Number 3. Choosing poor locations. Location is one of the most critical factors in real estate investing. Properties in high-crime areas, economically stagnant regions, or declining neighborhoods often struggle to attract tenants or buyers. Investors should carefully analyze the local job market, school quality, crime rates, and future development plans before purchasing. Even an excellent property in a bad neighborhood will struggle. Poor locations lead to higher vacancies, lower rents, and greater management headaches. Avoid this mistake by researching crime statistics, school ratings, median incomes, and planned developments for each area. Speak with local real estate agents and property managers to gain insight. Visit neighborhoods personally at different times of day to evaluate safety and desirability. Number 2. Overleveraging with excessive debt. While leverage can amplify returns, taking on too much debt exposes investors to significant risk. If rental income drops or interest rates rise, heavily leveraged properties can become unmanageable. Maintaining a healthy debt-to-income ratio and having an emergency fund can protect against financial hardship. Overleveraging often occurs when investors try to grow too quickly, Using maximum loans to acquire multiple properties without adequate reserves. Avoid this mistake by using conservative loan-to-value ratios, stress test your cash flow models under worst-case scenarios, and maintain liquidity. Avoid adjustable-rate mortgages unless you're fully prepared for rising payments. Prioritize long-term stability over rapid expansion. Number 1. Poor property management practices. Effective property management is essential for long-term profitability. New investors often underestimate the complexities of managing tenants, maintenance, and legal compliance. Poor management can lead to tenant turnover, legal issues, and financial losses. Whether self-managing or hiring professionals, investors must prioritize excellent property management to protect their investments. Tenant screening, clear lease agreements, timely maintenance, and legal compliance are just a few of the responsibilities required for success. Poor communication or neglecting tenant concerns often leads to costly vacancies and reputation damage. Avoid this mistake by managing yourself. Educate yourself on landlord-tenant laws, maintenance protocols, and tenant screening best practices. Otherwise, hire a reputable property management company that can handle these tasks efficiently. Treat property management as a core component of your business model, not an afterthought. If you find this video informative, hit that like button, subscribe, and turn on notifications so you never miss valuable real estate advice that could help you build lasting wealth. Thank you for watching, and see you next time.